it's Employment Day. So we are now doing this YouTube video on Employment Day. Before we get into the discussions today or the topics today, I'd like to mention that at the end of this video, we will put a link or we'll give you a link so that you can take a look at our swag for good. Now, this is by popular request, the swag, and we thought as part of our corporate responsibility that we could allocate all the profits to charitable organizations really focused on getting us out of the COVID-19 crisis, especially those who have been hardest hit. So take a look. We hope you like it. Very proud of our marketing team led by Sebastian, who really put all of this together. So with that, I'll go through the normal drill. Fiscal policy, there's a lot to say there. Monetary policy, market indicators, economic indicators, and a bit about innovation. And before I start, I know I've got why we do these macro videos when we're all about innovation. Well, I started my career in economics. Art Laffer of Laffer Curve fame was my professor at USC. And I've always felt it important to have perspective, just have a sense of the economic backdrop and the policy backdrop before I can really delve into any investing. So that's one reason. The other reason is because of my background and because I did start in the business in economics, I devour economic reports as they come out. It's a little bit of my daily diet. And I've noticed over the years that there are a lot of shortcuts in reporting. There's a lot of detail in the reports, and I don't hear a lot of details being mentioned when they are quite relevant. And that was true, especially during the coronavirus crisis. Now, I know we're still in somewhat of a crisis, but at the depths, it became easy to see very early on that we would end up in a V-shaped recovery. And I think delving deeply into those reports helped us with that point of view, and I hope it helped you as well. So we will start with fiscal policy. 1.9 trillion, it looks like that could be the case. Went through the Senate, Vice President Harris decided it. She was the deciding vote. And now it will go back to the House. Nancy Pelosi says she will have a bill no later than March 15th. So we may not get the 1.9 trillion, but it's going to be much closer to that than I expected. I expected a bit of a rapprochement at the beginning of the Biden administration. And what we're seeing instead is a decided turn, really, or decision to overturn a lot of the decisions that President Trump made and to push through this fiscal stimulus package aggressively. Now, even Larry Summers, who was, I think, the top economist on President Obama's team, is saying, wait a minute, the economy is already well on its way, and this is going to set it on fire. And I agree with that. And that will be a good thing. We will have a lot more jobs, but we will have a lot more policy decisions to make as the deficit mounts and maybe some inflation indicators start flagging here. So we will also see, I think, potentially the $15 minimum wage. Again, good for some, but I actually think that it will backfire. A lot of small businesses will not be able to afford it, and hopefully they will be able to get through to the administration, because it is those businesses that the Biden administration says need so much help, and they're right. A $15 minimum wage will not help, we believe. Monetary policy, well, M2 is still at 20, it's north of 25% still. And so far we're seeing the ramifications in asset prices. So stocks, bonds, housing in particular. Those assets are the beneficiaries of this very generous monetary policy. And we know that Chairman Powell says it's way too premature to think about pulling back. Even though the bond market itself is saying, well, it looks like the 10-year inflation expectations are 2.2%. The Fed wants north of 2%, but it wants to see the whites of the eyes of inflation at 2% or more. That will happen. And it will happen if for no other reason than the base effect. Last year, we were seeing declining prices during March and April, prices dropping at a rapid rate. And we're going to cycle against those comparisons. So we could see the CPI up at 4% by the summer. I still do not believe that the Fed will flinch. They will say this is temporary. It's just because of the comparisons, the base effect, and it's probably going to allow inflation to stay higher for longer than might have been the case in the past. Now, if you've been listening to us, we do not believe there will be an underlying inflation problem. In fact, the technologies around which we focus all of our research are all deflationary, and they're all hitting prime time in terms of exponential growth. So they're going to become more important, and the deflationary undercurrents in the economy are going to multiply, we believe. The other thing that's going to happen is there are a lot of companies, sectors, industries in harm's way because of innovation, and also because, especially the more mature ones, have been leveraging up to buy back their stock and pay dividends, when instead they should have been investing aggressively so that they won't be disintermediated and disrupted as these innovation platforms just plow across the economies around the world. So we're probably going to see both deflationary booms associated with these innovation platforms and deflationary busts associated with companies that are going to have to try and sell their wares at any price in order to service their debt as they are being disrupted or disintermediated. So those are two sources of deflationary power. One of them's good deflation, again, technological, and it will be associated with very rapid growth. The other one is bad deflation, and this is the deflation that Jeffrey Gundlach and Howard Marks and other more fixed income investors have been warning us about. And I agree with them. There is trouble on the horizon. The fixed income markets are not discerning quite enough yet, in fact, hardly at all. So we think there are going to be a lot of ramifications, especially for the fixed income markets. As far as the equity markets, we've had a great profit season generally. The V-shaped recovery is benefiting most industries, save for travel, leisure, hospitality. Those and other service sectors probably will catch a little fire this year as the vaccinations make their way through the population here and elsewhere. So earnings are looking really good. Now, there are some very highly valued stocks out there. They can't miss. So they do get hit if they miss. So I'm glad to see the market is discerning. It's a sign we're not in a bubble. We're seeing commodity prices. They're really starting to gain traction here. So another sign that the economy is doing very well. And we're seeing a counter-trend rally in the dollar. The dollar has moved up against most expectations during the last month or so. If the fiscal program that the Biden administration has proposed does find its way through Congress, then I believe the dollar could start to go down again, mostly with a focus on the fiscal deficit. There is a counterbalance to that somewhat, and that is our trade deficit is probably going to come down as more spending shifts back to services, which is more domestic economy, from goods, which many of our goods are imported. So that could give the dollar a bit of a reprieve from the downturn that has been in place for about a year. We'll see what the markets focus on more, the fiscal deficit or the trade deficit. So that will be an interesting dichotomy. As far as the economy, the employment report, this is what I mean by looking into the report. The employment report, the headline numbers were mixed. The unemployment rate itself came down from 6.7% to 6.3%, which was much better than the 6.7% expected. But employment itself, non-farm payroll employment, was 49,000. I think the expectation was a little north of 100,000. That is the number that most economists pay most attention to. And what we think they missed in this report were a couple of things. One, the average work week went up 0.3 hours, which is a huge increase. And it means, and it will be associated with a lot of economic activity. Sometimes that hours worked, and I've rarely seen it go up 0.3 hours during any 1 month. Sometimes, and that is much more important than the headline numbers. The other number that did not get a lot of attention was the average hourly earnings. They were up 0.2, expectation was 0.3, but the previous month was revised up from 0.8 to 1.0. So those two numbers were, I would say, on balance, better than expected. And I put a lot of weight on that average work week. So I think the economy is doing much better than the Biden administration is suggesting as it is trying to push through this very sizable fiscal policy package. In fact, I think this package is 3 times the size of the one put in place at the beginning of the Obama administration as they were addressing the worst financial crisis we've had since the Great Depression. So again, we think a fiscal policy package of this size is overdoing it. Then we have housing. It's on fire. I probably don't have to tell anyone here listening that news because if you're a homeowner, you know this. And I'm sure that's a source of great confidence. Capital spending looks great. We got non-defense capital goods orders this week, still going strong. Inventories have started to increase, but I would note that commodity prices are also continuing to increase, which suggests that the inventories are trying to catch up to where consumption has evolved over the past year. So inventories going up is absolutely essential. And we do think we're going to get a lot of growth from inventory growth before they reach excessive levels. Government spending, I just told you, that's going to be a source of great strength. And even the trade deficit will probably be a source of strength as we import fewer goods relative to the spending that's going to take place in the service sector. I think all this will wind up in some significant profit growth this year. I think much more significant than many economists and strategists expect. I think this last video I did, I said $200 for the S&P 500. That would be a run rate at the end of this year, but it could be close to that for the year as a whole if some of these explosive fiscal policy measures continue. One of the things that will happen if we get this fiscal policy package is the saving rate will go, it's already started to move up again. It will go from 13.7, probably back to 20% or even north. It peaked at 34% during the depths of the crisis. That is a huge amount of firepower that the consumer has moving forward. So the consumer will be benefiting from a nice cushion, good confidence associated with jobs and asset prices. So it will seem like a Goldilocks scenario. And underneath that, as I mentioned a little earlier, I think we're going to have two powerful forces moving against one another, you know, this deflationary boom and the deflationary bust. And it's going to be perhaps somewhat confusing, and we'll see how the markets start sorting it out. And now I'd like to spend a little bit of time on innovation. We put out our Big Ideas report, Big Ideas 2021, a week or so ago. And we're really happy. It's at ark-invest.com. And we're very happy that in the first, I think it was in the first day, we had 100,000 hits compared to 58,000 for all of last year, our Big Ideas 2020. So we're happy that it's making an impact. We have a lot to share, a lot of research to share, a lot of research conclusions to share. And I have to tell you, I do this full time, and when I pull back and just look at the big picture and where our research suggests that these trends are going, I have to tell you, I am even taken back sometimes when I think about the opportunities ahead of us. I'm just going to rattle off a few. And the reason they are going to happen is because the costs associated with scaling these new technologies, the costs have come down low enough that they're opening up new markets. Battery costs are an easy explanation. When we started the firm, I think the question was, would electric vehicles ever be economic? Would they ever take off? And today, of course, we're looking at electric vehicle prices soon to drop below gas-powered car prices on a like-for-like basis. And by 2025, the average car, like the Toyota Camry of the electric vehicle space, will be priced at $18,000 compared to $25,000, $26,000 for the average gas-powered car. And we know that electric cars are better from a couple of points of view. Certainly the environment, but also they're just better cars. If you use metrics like 0 to 60 miles per hour, how many seconds does that take? So we think for that, just that one part of the auto market is going to scale, this is a global number, at an 82% compound annual rate during the next 5 years. Think about that, anything growing that much. People just don't believe that's going to happen, but we do. We think there will be a wholesale shift so that we go from 2.2 to 2.3 million electric vehicle cars sold last year to 40 million in 5 years. And that will be almost half of all cars sold globally. and will probably have entered the autonomous realm as well. One of the reasons autonomous will happen is because artificial intelligence training costs are dropping by 37% per year. And we're seeing the size of artificial intelligence models growing by tenfold per year. So there's a huge amount of progress being made because the costs are dropping at such a rapid rate. And we can make this progress now. One of the reasons these models are growing so quickly is that to do natural language processing takes 10 times the computing power that computer vision demands. So, and we see the progress being made in natural language processing. I don't think we expected this for another 5 years. So even we have been taken aback at the progress. And I do believe a lot of it is associated with the costs coming down as rapidly as they are. We think that artificial intelligence is going to enable virtual worlds that I remember we used to talk about this 20 years ago, talking about how we would all be entering into virtual worlds with avatars and so forth. Well, I think virtual reality is on the cusp. And we would have told you, there was a debate in the firm, but we would have told you on balance, most of us did not expect it to take off 5 years ago. I listened to Unity Software, John Riccatello, who I knew from Electronic Arts in the day. He's at Unity, and he had also been saying that he didn't think virtual reality was going to be a thing about 5 years ago for quite some time. Now he says we're on the cusp. And this means we will be seeing virtual worlds converging, and we will be evolving towards the metaverse. And we think there's a creative explosion, and it's not just in gaming, it's probably in every sector. Again, artificial intelligence, a big part of that. Digital wallets, so bank branches in our pockets. We think this is a $4.6 trillion opportunity. And that's just in the US. We think there will be 200 million digital wallet holders. And again, these are going to be our bank branches. And this is why the financial services sector is in harm's way, we believe. But the aha moment that we have had in the last year, and we've been informed by what's happened in China, is that these digital wallets are going to be much more valuable than we once thought. We were defining that market in terms of financial services. But if you look at what happened in China with Tencent, you'll see that half of the screen is used for digital commerce or e-commerce, as well as social activities. So these digital wallets could become the most valuable technology developments per user of almost anything. So we're pretty excited about that. And what's also interesting is to watch Cash App and Venmo scale to surpass JP Morgan in the case of JP Morgan's deposit holders, 60 million. Venmo was there last year. Square has just about caught up. And if you were to draw a graph, as we did in Big Ideas, showing how JP Morgan got to those levels, it was one acquisition after the other. Whereas Cash App and Venmo, because they're viral in nature, have gotten there organically. So miles to go, lots of fun in that space. Part of fintech and digital wallets, of course, is Bitcoin. And we're astonished to see, we're not astonished to see the price elevate, because we expected institutional to become a bigger part. of the equation as we saw sort of the infrastructure moving into place. But what we didn't expect was that Bitcoin would become a part of the balance sheets of institutions. Square, 1% of its assets, 2% of its cash is in Bitcoin. MicroStrategy, I think, more than 100% of its cash is in Bitcoin. And just this week, MicroStrategy hosted a conference for institutional investors to show them the way, a good way to diversify your cash. And given everything going on in the DeFi space, the decentralized finance space, we wouldn't be surprised to see Ether moving in this direction. It's probably going to take a while. We think the more secure diversification into crypto will be through Bitcoin. And then automation. It took the manufacturing industry in the United States 15 years to go from 20 robots per 10,000 employees to 200. 15 years, and that took place through 2015. We believe that the same is about to happen to the entire economy, not just the manufacturing. We are right now at roughly 20 robots per 10,000 employees in the US economy. We believe it will only take 5 years to get to 200. And a lot of people are afraid when they hear that. They're thinking about their own jobs. But the history of technology is, yes, there will be displacement, but the history is that it will create many more jobs than it will destroy. So we are not afraid of this. Our brainstorm today, we had a big discussion about it. And one of the things we've learned from technology is we have no idea how many interesting new creative jobs are going to evolve during the next 5 years, maybe having to do with virtual worlds. We were also commenting on, working fewer hours. Well, influencers on Instagram, that's a job. I don't think they are working 8 hours a day. Maybe some are, but I don't think some of them need to do it, and they're making a very fine living. So the nature of work is going to change. And we were also talking about education as well. The nature of education is changing. Elon Musk this week, I believe, said that his school-age children are learning mostly through YouTube, and I think he said Twitter. It might have been another social network. We have some folks on our brainstorm each week who are basically saying the same thing. They'll tune into us for innovation, and then they go off to YouTube to do a little more exploration. So I think the nature of education is changing, and we're pretty excited about that. One of the interesting things about automation that I think many people don't understand is that part of what happens is that previously unpaid labor shifts into paid labor. So you can imagine all the food preparation, the shopping, the preparation, the cooking, the cleaning up. Now we have food delivery, and we think with drone technology, in 5 years, we're going to have at least, I've forgotten the exact number, but an astonishing amount of our food intake will be because of food delivery, and we'll have wonderfully diverse options, of course. Then as part of automation, autonomous ride hailing. And we think ride hailing today is about $150 billion market. We think it's going to $6 to $7 trillion by 2030. And at that point, it'll have about $1 trillion in operating income. Well, if we're right, then during the next 5 years, the market will start to discount that. And we think by the year 2025, that the ride-hailing category, most of it autonomous, will be approaching $4 trillion in market cap. So pretty astonishing moves ahead. If Tesla's right, 20% of miles driven in North America will be autonomous by the year 2025. We think it would be, we believe it's going to be closer to 7 or 8%. And if we believed that Waymo was right, given the pace at which it's approaching this market, it'd be maybe 1%, not even 1%. So we think Tesla's probably relative to expectations, much closer to the mark. And drones are going to change our lives. If you think there's going to be a collapse in transportation costs, because of course drones are autonomous as well. And even the difference between remotely piloted drones and completely autonomous drones, the difference in cost to send a package 10 miles would be $7.80 per mile for the remotely operated drone versus 25 cents per mile. Now, this is all at scale. In the early days, of course, everything costs much more than that, but we're talking about scale. So, and here I do have the statistic. We believe that by 2030, 19% of all food deliveries will be by drones, and that will be a $116 billion market. Another very interesting section in our big ideas is Orbital Aerospace. And if there's one space that we've seen all of our technologies converging, it is in orbital aerospace. And we think the opportunities there are vast as well in the global connectivity market, which is what a lot of people think about when they think about orbital aerospace. They think about all the satellites that SpaceX is sending out there to help with global connectivity. That's a $40 billion market, total available market. 10 billion of which, believe it or not, is in the US, in our rural areas, and 30 billion in the rest of the world. The bigger market, we believe, is hypersonic flight. So going from New York to Tokyo in 2 hours instead of 13 hours. We believe, and we believe our estimates are conservative, that's a $270 billion market. So think about that. I don't know what kind of multiple of sales you put on 270 billion for orbital aerospace. And of course, that's just the beginning if you believe Elon Musk and are aiming for Mars. 3D printing, we think the reason it is starting to take off, as so many other innovations do, is it solved problems during the coronavirus. 3D printing parts for ventilators, face shields, and so forth. So it is emerging from the valley of despair, and we think that there's combined with artificial intelligence, we think this is a $120 billion market in 5 years. And then finally, in the genomic space, we focus on long-read sequencing, which is going to be transformational. It is much more accurate and reliable than short-read sequencing. And so we're excited about the multi-screening cancer opportunity that we think by 2025 will reach a low enough cost with long-read sequencing so that it will pay, reimbursement will be there for those 40 and over. So we can all start screening earlier for this disease associated with older age. and either prevent or cure, please God, with gene editing, cancer in stage 1. And finally, one of the biggest breakthroughs in cancer we've had is immunotherapy, of course, where the way we've described it historically, we are able to train our own immune system to recognize and fight cancer. And that's with our own T cells. Well, now we're moving to off the shelf. What I've just described is very expensive and very painful in some ways. The new way is allogenic. So autologous is the old way. Allogenic, and there'll be a place for both of them, I'm sure, is really taking anyone's cells and training those cells to treat anyone else's body to fight and kill cancer. And we think that will be a $250 billion opportunity in the next 5 to 10 years. So lots of opportunity, lots of hope, lots of excitement. I hope you read our Big Ideas to learn more about it, Big Ideas 2021 at arc-invest.com.